Hello and welcome to our market alert video for today, August 2nd, 2024. And boy, did we get some bad news. And of course, the market reacted accordingly. And so I want to go over that with you and what our analysis and where we think we go from here is. But before we do that, I am Ken Moraif. I'm the founder and CEO of Retirement Planners of America. And our firm has a singular goal, which is to create as many Squippers as we possibly can. And Squippers is the acronym for Second Childhood Without Parental Supervision. So when a client of ours retires, we call them a Squipper. We want them to go play, have fun, enjoy life, and let us do the worrying about all this boring financial stuff. Let us get the gray hairs for you so that you don't have to. So let's talk about what happened this week. The news this week seems to be a continuation of the drumbeat that things are deteriorating. And the problem is not that the news all by itself was so horrible, although it wasn't good news, but that it seems to be accelerating. And that's really the concern right now. So what we got was jobless claims were up higher than expected. Manufacturing was lower than expected. Unemployment went up to 4.4% when it was expected to be 4.1%. And the number of new jobs created was 114,000 when it was expected to be 175,000. So the misses on expectations are becoming larger. So the momentum seems to be getting accelerating on the downside, on the bad side. And the thing that is especially concerning about that is that what has held up and held people's confidence, despite the fact that the economy has been slowing down in many areas, real estate and others, is that people were retaining their jobs and the consumer was spending, and therefore we were going to have what people have been calling a soft landing. Well, if people are losing their jobs or not getting jobs that they want, and we start seeing unemployment become a problem, then that leg, that support that's been holding up the economy goes away, and that could be a big problem and create a bad recession and a big bad bear market with it. Now, there's precedent for this, and that was in the 80s. Paul Volcker, who was combating inflation at the time, the worst inflation we've had in the modern era. And he did the same thing. He basically waited too long to start lowering interest rates. The economy went into a very bad recession, and the stock market had a terrible bear market to go with it. So that's the concern right now, which is why you're seeing, the stock market behaving as it is. Now, at the beginning of this year, if you watched our videos, you know that we said that we anticipated not that there would be 7 rate cuts starting in March, as many people and big banks and economists were all saying. We said, no. That won't happen until the second half of this year, after July. And sure enough, right now, the odds are that in September, the Fed is going to lower interest rates. The talk now is even that they might lower interest rates 3 times before the end of this year. So we also said that in the second half of this year that we anticipated that bonds would perform better than stocks. And so far in the second half of this year, that has been exactly the case. We said to buy bonds. We said that we actually bought bonds for our clients back in late December of last year in anticipation. The bond aggregate index, which is the aggregate of bonds, historically, if you look back at history, has gone up significantly when the Fed lowers interest rates. And so therefore our anticipation was the Fed is going to lower interest rates, and if they do, bonds could do very well. That bond aggregate index is now up over 4% in the last month alone on the anticipation of these rate increases, and we think that will continue. So on the bond side, we're very strong on the mid to long-term bonds. We think they're going to do very, very well in the second half of this year. From the stock side, we don't think there's going to be a massive bear market, as a lot of people seem to be anticipating right now, but it's certainly possible. And that's why we have our invest and protect strategy. And we want to participate as much as possible in the upside, but if it turns south and it loses and the market drops like a stone, we want to have a strategy for our clients to protect against that. And our strategy actually told us to sell in November of 2007, before the stock market crash of 2008. Told us to sell literally the day before the pandemic was announced in 2020, and also in April of 2022. And you know what happened in both of those instances, how far down the market went after that. So we want to protect against not only the lowering of interest rates and a recession, which bonds should do well in that scenario. They call them the bond ghouls. They like bad news. But from the stock side, if we get that, then we want to have a strategy to address that as well. And we think you should as well if you are over 50, if you are retired or retiring soon. So strategically, that's where we sit, and we think we're in a good place. Share this video with as many of your friends and your family as you would like. We want to create as many Squippers as we possibly can. Maybe you'll decide to visit with us and become a client as well. But certainly, thank you for watching, and I hope this video helps you to have some idea of where maybe you should go and have some peace of mind about the whole thing. All right, so thanks for watching this video, and we will talk. Oh, before I go, you may be wondering why I'm wearing a Stars and Stripes. This is actually my United States Olympic team support shirt. So go Team USA. So there you go. Thanks for watching, and we'll talk soon.